Home affordability is becoming one of the hottest topics in the economy, but I was recently asked if assumable mortgages might bring some relief to home buyers. With skyrocketing home prices, the steep rise in mortgage interest rates, and soaring rents, today's shelter seeker can find no respite from today's higher costs. The continued lack of inventory of homes for sale and homes for rent means that we must anticipate prices and rents continuing higher. But if we could just only use interest rates from a few years ago by assuming a mortgage, today's home affordability levels would be tolerable. For example, with a recent rate spike pushing above 6%, how exciting would it be to find a home with a 2.25% assumable loan? Considering today's rate is more than double those from recent past years, the assumable loan could have relevance again for the first time in over 30 years. For some buyers, it could be possible to use a mortgage assumption to reduce the cost of borrowing money on the next homes that they purchase. So today, I intend to dust off some foggy memories of loan assumptions and show how they could impact today's home affordability crisis. Before I continue, I want to tell all new viewers here that the home affordability crisis is no joke. Maybe you've owned a home for a while and it's not impacted you, but both tenants and buyers currently in the housing market are getting floored. Today's relative cost for shelter is higher than it's been for more than 31 years. When we adjust for inflation, today's cost of housing is highest. When we adjust for wage growth, today's cost of housing is highest. No matter how you break it down, new homeowners and tenants are having to spend more of their disposable income on shelter than any time in recent years, and the problem is getting worse. The purpose of today's video is to answer a recent question about the benefit of assumable loans and whether or not they could ease the pain of a housing market in great peril. And by the way, if you're a new visitor to our channel, you should know we answer frequently asked questions as well as questions received in the comment section below our videos. Please give us a thumbs up to tell YouTube that this is a video worth watching, and then subscribe to our channel so that you get all of our content when it is fresh. We focus on the facts, not hype, so give us a try. So what is an assumable loan? There are home mortgage loans that have been written and that are being written today that allow for home buyers to assume or take over for the seller. Thus, when a seller sells a home to a buyer who assumes the mortgage, the new buyer just starts where the seller left off on repaying the loan. Of course, the purchase price will require the buyer to pay other closing costs and bring the down payment necessary to cover the full sales price. I'll have more on that later. The key is that buyers get to take over a mortgage that has a much lower mortgage interest rate than today's rate and already has several months or years paid down. This will result in a lower monthly payment, a shorter repayment period, but most likely a larger down payment to close on the home. In order to have a mortgage assumption, the home seller must have an assumable loan. It's important when marketing a home for sale that sellers let their listing agent know if they hold an assumable loan. If sellers are not sure, get the loan papers to the agent and the agent will be able to figure it out. So you might be wondering, what type of loans will you likely find to contain positive clauses for assumption? For the most part, FHA, VA, and USDA loans will contain language that allow for assumptions. Typically, conventional loans will not, though in some cases, adjustable loans may have an assumable feature, but that kind of defeats the purpose of assuming unless the current market rates move much, much higher. There might be positive language in other loans for assumptions, but you would need to check each and every loan type to be sure. Fortunately, the first 4 loan types listed prior represent more than 80% of the home mortgage loans we've seen locally. There are 3 primary types of assumable loans that you're likely to encounter when buying a home today. First, there's VA loans. Homes with VA loans can be the biggest opportunities in the market. There are no loan limits, and the loans can be assumed by veterans and non-veterans alike. When assumed by a veteran, this is best for the veteran seller because the buyer can substitute entitlement for the assumed loan so that the seller regains the VA entitlement associated with the loan. This allows the seller to go out and buy another home with a new VA loan. When assumed by a non-veteran, although the veteran seller is not liable for the mortgage after the buyer has credit qualified, the veteran seller's entitlement is tied to the loan until such time as the non-veteran buyer pays off the mortgage. Case in point, I know of numerous friends of mine who refinanced their homes with VA loans over the past 4 years and have rates at 3% or lower. They can now sell their homes with an assumable loan of up to 3% versus today's rate of roughly 6%. Second is FHA loans. FHA loans always have an assumption clause and can be great opportunities for buyers within price ranges that FHA loans service. And it's a very large segment of the Tallahassee real estate market. For FHA loan assumptions, buyers must credit qualify and the seller is released of liability, meaning they get novated. The day of non-qualifying assumable FHA loans are long behind us. The loans have all matured. And finally, there's USDA loans. USDA loans can also offer opportunities in some cases for buyers, as these loans are originally written to help households with very low to moderate incomes purchase safe and affordable homes in rural areas. One should only expect to find assumable USDA loans in rural areas and for homes priced in the bottom half of the local home prices. When assuming USDA loans, there are limitations on buyers' income and the price of the home. For example, in my market area, the current Leon County household limit is $91,900 for a 1 to 4 person household. This means that households with income levels above this point would not qualify to assume the existing USDA loan. That's right, the buyer must qualify to assume a mortgage. Just like any other mortgage loan, a buyer must qualify to be able to make the assumption. And the first rule on the qualification test is that it must be for an owner-occupant, meaning no investors. I believe this rule was put in place due to the abuse caused by investors in the savings and loan crisis in the 1980s. It would be a mistake to believe that assuming a loan is a good way for somebody with poor credit to buy a home. The full qualification process one must endure to be approved for a mortgage is the same one buyers must undergo to qualify for a mortgage assumption. In the case of the assumption, buyers apply with the seller's lender. In order for you to get a feel for how assumptions work, let me share a real-world example of a home purchase. Somebody who purchased a $400,000 home in July 2020 by putting 5% down was able to get a 3% interest rate for their mortgage loan. Pretty awesome. 3 years later, that buyer decides to sell. The likely sales price, based on past and current market appreciation, is going to be a whopping $570,000. So let's see how the $570,000 sale would look like with a mortgage assumption. In July of 2023, the mortgage balance to assume will be $364,000. That means a buyer with 3% in closing costs will need to bring $223,000 to the closing table for the right to assume the seller's mortgage. Think about what this means. When the seller purchased the home, the down payment was $20,000 and the closing costs were about $12,000 for a total of $32,000 out of pocket. The new buyer, due to soaring home prices and soaring mortgage interest rates, will need $223,000 out of pocket for the right to have the same monthly payment on the home. That's nearly a 600% increase in out-of-pocket costs for the buyer in just 3 years. Is there a better example of home affordability crisis than this? The hidden gotcha in all of this is that most people thinking that loan assumptions are going to get popular forget that we're currently struggling through a low supply market with a strong demand from cash buyers and well-qualified buyers. Now that you know it takes 30 days or so to get a loan approval from a seller's lender, can you imagine how well an offer would be considered when it compares to other offers that can close before an assumption offer can even get qualified with a lender? Not in today's world. Another great hurdle to loan assumptions becoming useful is the fact that as more time goes by, the more a loan is paid down and the less that is owed. Thus, when it comes to assuming a mortgage, sooner is typically better if the buyer is trying to reduce the down payment. If well-educated consumers or real estate agents are involved, you might see a smart use of a combination of an assumable loan and a home equity line of credit, a HELOC, used for the purchase of a home with an assumable loan. This would need to be arranged with the HELOC lender in advance, and the buyer would still have to qualify for the assumable loan. This combination only works in a future where there are far fewer bidding wars on homes and cash investors are not showing up in force. Perhaps once we see the supply and demand relationship return to more normal conditions or even move towards a buyer's market, then we could very well find ourselves with a solid use for assumable loans. I'm concerned that we won't see those days anytime soon. So to wrap this up and answer the question, will assumable loans save housing? I expect assumable loans will catch headlines and we'll see some shock and hype videos for a few years on YouTube. After all, assumable loans sound exciting. With today's rate of over 6% and an assumable loan potentially going below 3%, how could that not be an exciting deal? There will be a lot of people who partially understand this that will claim loan assumptions to be the key to the kingdom. But I just don't think this will come to pass. When you factor in the supply imbalance, as well as the large equity requirement to assume a loan as an owner-occupant, I just do not believe that assumable loans will garner the attention today as they did in the 1980s and early 1990s when I started in the business. There's just too much momentum in these areas for loan assumptions to gain traction anytime soon. I am hoping that a forward-thinking lender will develop products that encourage and allow buyers to assume loans and couple them with a HELOC or a similar product designed to reduce the down payment requirement while also reducing the blended mortgage interest rate. Unfortunately, even if this comes to pass, will sellers be willing to wait to discover a buyer's ability to close when they're also considering a cash offer from an investor who can close in a short time frame? I really don't think so. It is the institutional investor entering the traditional mom-and-pop housing market that makes me think the assumable loan won't be a big hit this time around. If you want to see a video featuring my 9 tips for buying a home in a highly competitive market, you can view it by clicking on the box on the top left corner of your screen. To see a popular video featuring my top 6 home selling tips, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.